Here's our mortgage rate outlook for the month of June. So I'm bringing you the latest update and insight on the financial markets and interest rates. So today we're going to discuss the developments in the rate outlook for June and how they're shaping up the investment landscape. So let's start with last month. So we definitely missed the mark again for the second month in a row as we saw some gray swan events, and May 10th really wasn't much of an impact in any way. So we'll discuss these events shortly, but for June, we are definitely recommending a lock bias with a confidence score of 6. And remember, that confidence score is on a scale of 1 to 10, 10 being the most confident. All right, so let's start with the Fed minutes. So the Federal Reserve released their minutes earlier this week, and we saw their stance on interest rates. So it's quite evident that the Fed officials are really facing a close call when it comes to potential rate hikes for June. So the probability of a rate hike in June has taken a significant plunge, really causing a stir in the financial markets. So analysts and traders alike are really scrambling to try to understand the implications of this unexpected shift. So allow me to shed a little bit of light on the matter. So first and foremost, credit market stress has played a pivotal role in dampening the chances of a rate hike. So uncertainties and potential vulnerabilities in the credit sector have made the Federal Reserve a lot more cautious about tightening monetary policy. This increased prudence has been mirrored in the futures market as investors adjust their expectations accordingly. To say there's volatility in the market right now is a gross understatement. So another factor weighing heavily on the rate outlook is the recent budget deficit negotiation. The breakdown in negotiations has created a lot of additional uncertainties, further reducing the likelihood of a rate hike in June. So this cautious sentiment is crucial to understanding because it can potentially have a tightening effect on the overall economy. As banks become more risk adverse, they may tighten lending standards and reduce credit availability, affecting both consumers and businesses alike. So banks are forced to sell bonds, which is one of the main reasons we have seen rates move up from the April lows. These two major events of the budget deficit and the increased stress on the banking system has caused uncertainty and rates to move up. Even if the budget crisis is solved, the stress on banking will continue, and this will continue to hit rate sheets in the near future. So although inflation seems to be heading downward, the trend is a lot less pronounced than we expected, which is one of the reasons May 10th was such a non-event. I expect more difficulty, volatility, and uncertainty in the upcoming months.